Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Scholastic CORP quarterly report. Scholastic Corporation offers a diverse range of businesses and services that cater to children's educational needs. The company provides children's book publishing and distribution, digital and audiobooks media, and interactive products through school reading events and trade channels, school-based book clubs, and book fairs, original publications, including popular series such as Harry Potter and the Hunger Games, licensed properties like Peppa Pig and Pokémon, educational materials and programs for classrooms, classroom magazines, print and online reference and nonfiction products, consulting services, film and television content development, production, distribution, and licensing, international book publishing and distribution in English, Hindi, and French languages, school-based marketing channels, supplemental educational materials, including professional books for teachers. These businesses and services are distributed through various channels, including direct sales to schools and libraries, retail stores, and the Internet. The Scholastic Corp stock price has experienced a significant drop of over 19.7% in the past year due to several contributing factors. One major reason is the company's weak financial performance, particularly its third-quarter results, which missed Wall Street's expectations for both revenue and earnings. Additionally, the company reported disappointing Q1 FY26 revenue and EPS below analyst estimates, leading to a sharp stock drop. Furthermore, Scholastic's fiscal fourth-quarter results fell short of expectations, with revenue down 10% year-over-year and earnings missing Wall Street's estimates. The company cited a slowdown in supplemental curriculum purchases by schools and increasing pressure on consumer spending as reasons for the impact on its education solutions and school book fairs businesses. The volatility of Scholastic's shares has also been noted, experiencing 20 moves greater than 5% over the last year. The company's struggle with consistent long-term revenue growth and shrinking operating margin have contributed to its stock price decline. Overall, these factors have led to a significant drop in Scholastic Corp's stock price over the past year. The primary drivers of revenue growth or decline can be attributed to a few key factors. On the growth side, the company has seen an increase in digital product sales by 15%, as well as growth in international markets by 12%. Additionally, revenues from school reading events have increased due to higher redemptions of book fair incentive program credits. On the other hand, revenue decline can be attributed to a decrease in print book sales by 8% and a significant drop in education solutions segment revenues by 28%, primarily driven by delayed or reduced school funding. Lower production revenues in the entertainment segment and lower trade channel sales have also contributed to the decline. The net income and profit margins decline due to increased costs. The company's net income decreased by $8.6 million, or 13.7%, from $-62.5 million in 2024 to $-71.1 million in 2025. This decline is attributed to a significant increase in the cost of goods sold, which rose to 54.7% of revenue, up from an unspecified percentage in 2024. The profit margin also decreased, although the exact figure is unclear due to an apparent error in the report. The lack of specific reasons for the net income decline suggests that the company's financial performance was impacted by operational or market factors not disclosed in the summary. The company's financial performance indicates a significant issue with its operating cash flow. Despite generating some positive cash inflows in certain periods, the overall trend is negative. In 2025, the net cash provided by operating activities was $-81.8 million, and in 2024, it was $-41.9 million. Furthermore, as of August 31, 2025, the company reported a substantial deficit of $-1,444.6 million in its operating cash flow. This suggests that the company is struggling to generate sufficient cash from its operations, indicating a negative impact on its financial health. And the company's debt level and interest expenses have undergone significant changes over the past year. Notably, the total debt has increased by $100.1 million from $231.1 million in August 2024 to $331.2 million in August 2025. This increase is largely driven by a rise in long-term debt, which grew from $225 million to $325 million. Consequently, the company's interest expenses have also increased, rising by $1.2 million from $3.8 million in 2024 to $5 million in 2025. Furthermore, projections indicate that this trend will continue into fiscal 2026, with anticipated borrowings expected to drive higher interest expenses. Overall, the company's debt level and interest expenses have experienced significant growth over the past year, indicating a notable shift in its financial landscape. The company's financial performance varied across different segments and regions in the given period. The trade channel in the U.S. and international markets, excluding major markets, showed significant growth of 5% and 20%, respectively. Asia also performed well due to increased revenues and lower operating costs. On the other hand, several segments struggled. Children's book publishing and distribution experienced poor performance in school-based book clubs and fairs. The education solutions businesses in the U.S. declined by 28%, while the entertainment segment in the U.S. saw a 13% drop. International major markets were flat, but reported negative operating income. The education solutions segment was impacted by a volatile funding environment, leading to delayed or reduced purchases from schools. The entertainment segment faced lower production revenues due to delays in production demand. Management is expressing cautious optimism about the company's outlook despite several challenges. They acknowledge that their business is highly seasonal due to school year-based operations, which may impact revenue during certain periods. Additionally, they are concerned about the newly imposed tariffs, which will increase costs by approximately $10 million in fiscal 2026. Furthermore, higher interest expenses are expected due to increased borrowings under a U.S. credit agreement. However, management is confident in the company's liquidity and capital allocation strategy, stating that they have sufficient funds to support ongoing operations while also investing in existing businesses, making strategic acquisitions, and enhancing shareholder value. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company declared a quarterly cash dividend of $0.20 per share for the second quarter of fiscal 2026, while also paying out significant amounts in previous years. Additionally, the company has been actively buying back shares, with $5 million of common stock repurchases made in the prior fiscal year quarter. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights potential issues with inventory buildup and supply chain disruption. Specifically, the education solutions segment experienced a significant decrease in revenue due to delayed or reduced school funding, which may lead to inventory buildup. Additionally, higher royalty costs and newly imposed tariffs are expected to increase the cost of goods sold during peak seasons. Furthermore, increased inventory purchases and higher tariff payments will also impact the company's bottom line during peak selling seasons. These factors collectively indicate concerns about inventory buildup and supply chain disruption that need to be addressed. That concludes the financial summary for Scholastic CORP. Feel free to comment below, and I will be happy to answer them when possible.